Have you ever wondered why the market suddenly moved after a certain news? In this video, I'm going to talk about some of the most important macro data that matter most. These types of economic data matter more than anything else. And once you understand them, you're going to start seeing the market in a different perspective that align with the market behavior. So come along with me. Let's go. Inflation data, employment data, and growth data. They shape how central banks think, how businesses perform, and how investors position themselves. When inflation rally, central bank, for instance, the Fed, will have no choice whether to hike interest rates to strengthen the economy and pressure risk assets, basically to slow down inflation. When inflation cool off, central bank, the Fed, may decide to cut interest rates, and this potentially weaken the currency and strengthen the stock market. Then you see the stock market rising and risk assets gaining traction. This isn't random, it is the work of inflation. That is why you see data like CPI, PPI move the market, not because of the numbers themselves, but because of what they imply about future monetary policy. On the other hand, the labor market shows you the true health of the economy from the ground up. Strong job growth, low unemployment rates, rising wages. This potentially means the consumer have enough cash flow to spend and to support the economy growth, and this could possibly fuel inflation. For instance, when more jobs are added and people earn more, this could potentially add more money in people's pockets and increase their spending on goods and services. And this is where the actual inflation comes from. These are the real drivers of inflation. Potentially, it influences the interest rate decision, how the Fed think. Weak unemployment signals economy slowdown and a rising risk economic recession. And you know, this could push the central banks towards cutting interest rates. That is why reports like NFP, unemployment, wage growth are crucial, because they reveal whether the economy is stable or overheating. Markets priced in quickly based on that direction. Growth data reveal whether the economy is expanding or contracting, basically how sustainable that expansion is. GDP, retail sales, industrial production give a broader picture of demand, production, and business activities. Strong growth attract investors, capital, strengthen the currency and equity. Weak growth concern about recession, earnings decline, and financial stress. Growth data ties everything together because it shows the real outcome of inflation and employment dynamics. So when you understand how inflation drives policy, how employment strengthens the economy, how growth confirm or contradict both, then you can start anticipating how the market reacts instead of reacting to the news headlines. I hope this helps.